This is Mr. AG Asian Guy, and what happened on Tuesday changes everything we need to talk about regarding the momentum trades of 2026. Gold crashed over 5%. Silver absolutely plunged more than 11% in a single session. South Korea got destroyed with the EWI ETF down 14% in one day. Mining stocks across the board saw some of the most violent selling we've witnessed all year. And here's the thing that makes absolutely no sense. This is happening while war is escalating in the Middle East, while Iran tensions are hitting levels we haven't seen in decades, while geopolitical uncertainty is at extreme highs. Gold and silver are supposed to be safe haven assets. They're supposed to rally during crises. They're supposed to be where money flows when the world gets dangerous. Instead, they're getting absolutely hammered alongside everything else. Something doesn't add up here, and we need to break down exactly what's happening and what it means for what comes next. Before we dive into the data, drop a comment right now and tell me where you're watching from, what city, what country. I love seeing how global this community has become. We've got viewers from all across Asia, from North America, from Europe, from everywhere around the world. Let me know where you're tuning in from today, because these moves affect everyone, regardless of geography. Whether you're watching from Tokyo, Singapore, Seoul, London, New York, Sydney, wherever you are, let me know. Now, let me be absolutely clear about something important before we continue. I don't sell courses, I don't sell signals, I don't sell mentorships, I don't sell anything. If anyone reaches out to you claiming to be me and trying to sell you something, block them immediately. That is not me. I am only on YouTube and X. My handle on X is Mr. AG Asian Guy. That's the only way you know it's really me. What I do here is break down the data, show you both sides of every situation, and help you understand what's actually happening so you can make better decisions for yourself. I'm not here to pump. I'm not here to spread panic. I'm here to give you clarity in a world full of noise and manipulation. If this kind of real-time analysis helps you understand what's happening in these volatile markets, make sure you join our WhatsApp community. The link is in the description below. That's where we share updates as things happen, discuss market movements in real time, and build a community of people who actually want to understand rather than just react emotionally. Also follow us on X at Mr. AG Asian Guy, because that's where I post quick updates throughout the trading sessions across different time zones. Now let's get into exactly what happened on Tuesday, because the numbers are staggering. Spot gold crashed down more than 5% to $5,041.81 per ounce. Gold futures dropped 5% to $5,049. Let me put this in perspective. A 5% move in gold in a single session is massive. This isn't normal volatility. This is panic selling. This is forced liquidation. This is something breaking. Silver got hit even harder. Futures tied to silver fell more than 8% to $81.23 per ounce. At one point during the session, spot silver was at $79.99, down over 10% intraday. Some reports had silver down as much as 11% at the lows. This is the kind of volatility we saw during the worst moments of 2020. The kind of moves that shake out weak hands and create panic. But here's what you need to remember. Despite these massive single-day drops, gold is still up more than 16% year-to-date. Silver remains higher by more than 15% for 2026. Silver is still up over 161% year-over-year. Let me say that again, 161% year-over-year gains, even after Tuesday's crash. The pullback is violent, yes. But the underlying trend remains massively bullish when you zoom out. South Korea got absolutely destroyed. The iShares MSCI South Korea ETF, ticker EWY, plunged 14% in a single session. 14%. For a country ETF, that's an extraordinary move. And yet, even after that crash, it remains higher by nearly 30% year to date. These were the momentum trades of 2026. Gold, silver, South Korea. They all caught bids as investors nervous about their exposure to U.S. large cap tech sought out different asset classes that could better perform the market. Think about the context here. The S&P 500 shot up 64% on a cumulative basis over the last 3 years. That's an insane run in U.S. equities. And this year, the S&P is actually down 1%. Money has been rotating, investors have been diversifying, and gold, silver, and South Korea were the primary beneficiaries of that rotation until Tuesday happened. Now let me break down the mining stock carnage, because this is where the pain was most severe. Goldfields plunged nearly 13%. Anglo Gold Ashanti fell over 13%. Kinross Gold dropped more than 10%. Agnico Eagle Mines declined nearly 9%. Newmont fell nearly 9%. These are the major gold producers. the companies that should benefit from $5,000 gold, and they got absolutely crushed. Silver miners were hit even harder. Silvercorp metals fell nearly 12%. Pan American Silver dropped over 10%. First Majestic Silver fell over 13%. The leverage that mining stocks provide works both ways. When metals rally, miners outperform. When metals crash, miners get destroyed. Tuesday was destruction. Comment below and tell me if you hold any mining stocks and how you're feeling after Tuesday. Are you panicking? Are you buying the dip? Are you holding steady? I want to know how this community is handling this volatility, because what you do in moments like this defines your long-term results. Now let's talk about why this is happening, because the mainstream narrative doesn't make sense. The official explanation is that fears about the war in Iran could go on for longer than expected triggered the selling. But wait, if war is escalating, shouldn't gold be rallying? Isn't that the whole point of safe haven assets? You buy gold because when things get dangerous, when uncertainty spikes, when geopolitical risk increases, gold protects you. Instead, gold and silver are getting caught up in a broad selling frenzy. Investors appear to be indiscriminate in dumping assets they fear may have gone too far too fast. This is the profit-taking explanation. These momentum trades ran so hard in 2026 that when any excuse to sell appeared, everyone rushed for the exits at once. There are other factors at play. A stronger US dollar is dampening the appeal of non-yielding assets like silver and gold. When the dollar strengthens, it makes metals more expensive for international buyers and typically pressures prices lower. The potential for rising interest rates, or at least rates staying higher for longer, also hurts the appeal of assets that don't pay yield. Oil prices are spiking on the Iran war fears. Brent crude topped $84 a barrel. WTI crude jumped above $77. Rising oil prices revive inflation fears, which theoretically should be bullish for gold. But in the short term, the inflation concern is driving fears of tighter monetary policy, which is bearish for metals. It's a complex dynamic where the immediate reaction doesn't match the longer-term implications. Let me give you the historical context on silver specifically, because the magnitude of this pullback needs perspective. Silver's all-time high came on January 29th at a whopping $129.64 per ounce. That was the peak of the mania, the blow-off top. Since then, silver has pulled back significantly, and Tuesday's crash took it down to around $80. That's a decline of roughly 38% from the all-time high. But here's what matters. Silver is still up over 161% year over year. Even after the crash, even after the volatility, even after the profit taking. If you bought silver a year ago, you've still more than doubled your money. The pullback feels painful because we remember the highs, but the underlying performance remains extraordinary. Gold hit its all-time high of $5,594.82 on the same day, January 29th. The correlation between the gold and silver peaks is not coincidental. That was the moment of maximum euphoria, maximum momentum. And everything since has been digestion, consolidation, and violent shakeouts. Now I want to hear from you. Where do you think silver goes from here? Comment below with your prediction. Does it bounce from the $80 level? Does it break lower toward 70 or 60? Does it recover back toward 100 by the end of the quarter? Let me know what your gut is telling you, because I've found the collective wisdom of this community is often more accurate than the so-called experts. Let me break down what was driving each of these momentum trades, because understanding the thesis helps you evaluate whether Tuesday changes anything fundamental. Gold's thesis has been built on central bank diversification away from the US dollar. Countries around the world, particularly China and Russia, have been accumulating gold at record pace. They're reducing their dollar exposure and increasing their hard money reserves. Many analysts remain confident that gold could top $6,000 an ounce because this structural buying isn't stopping. Central banks don't trade momentum. They accumulate strategically over years and decades. Tuesday's crash doesn't change their buying programs. Silver's thesis has been built on tight supply-demand dynamics combined with big industrial use cases around AI and green energy. Solar panels require silver. Electric vehicles require silver. The data center build-out powering AI requires massive amounts of silver. Supply has been constrained while demand has been expanding. This fundamental picture hasn't changed because of one volatile Tuesday. South Korea's outperformance has been driven by worldwide demand for memory chips. Samsung Electronics and SK Hynix account for a huge part of the country's Kospi index. These two memory powerhouses are up more than 50% and 44% year-to-date, respectively, even after Tuesday's carnage. The AI boom requires memory. Every data center, every server, every device running AI applications needs memory chips. South Korea dominates that supply chain. So the question becomes this: did Tuesday fundamentally change any of these theses? Did central banks suddenly decide to stop buying gold? Did silver's industrial demand suddenly disappear? Did the AI memory chip boom suddenly end? The answer to all of these is obviously no. What happened Tuesday was momentum unwinding, profit taking, forced liquidation of over-leveraged positions. It was technical, not fundamental. But here's where I need to present both sides, because that's what we do on this channel. I don't just give you the bull case and pretend the risks don't exist. The bearish case for what happened Tuesday and what could come next. First, the magnitude of the moves suggests something may have broken. When gold drops 5%, silver drops 11%, and mining stocks crash 13% in a single session, that's not normal profit taking. That's forced selling. Someone got margin called, some fund blew up, some positions were liquidated involuntarily, and when forced selling happens, it can cascade. One liquidation triggers another, which triggers another. Second, the fact that safe haven assets sold off during a war escalation is a warning sign. It tells you that correlation is going to 1. Everything is selling together. This happens during true panic events, during liquidity crises, during moments when cash becomes king and everything else gets dumped. If we're entering that kind of environment, the selling may not be over. Third, the momentum trades may have simply gone too far too fast. Gold up 16% year to date, silver up 15%, South Korea up 30%. These are massive moves in a short period. Mean reversion is a powerful force in markets. What goes up too fast often comes down just as violently. Fourth, dollar strength could continue. If the Federal Reserve keeps rates higher for longer, if inflation remains sticky, if the U.S. economy outperforms expectations, the dollar could strengthen further. A strong dollar is a headwind for gold, silver, and emerging markets like South Korea. Fifth, if the Iran war does escalate significantly, the initial response in markets is often liquidation, not safe haven buying. People panic, they sell everything, they raise cash. The safe haven bid only emerges after the initial panic subsides, which can take days or weeks. Those are the bearish risks. They're real. You need to factor them into your thinking. Now, the bullish case for why Tuesday might be the buying opportunity of 2026. First, the fundamentals haven't changed. Central bank gold buying continues. Silver supply demand remains tight. AI memory demand keeps growing. Tuesday was a technical event, not a fundamental shift. When technicals diverge from fundamentals, fundamentals eventually win. Second, the year-to-date performance remains massively positive. Gold still up 16%, silver still up 15%, South Korea still up 30%. Zooming out, these remain the best performing asset classes of 2026. One bad day doesn't erase months of outperformance. Third, the year-over-year numbers for silver are extraordinary. 161% gains even after the crash. This is a generational bull market in precious metals. Bull markets have corrections, they have violent pullbacks, they shake out weak hands, but they don't end because of one ugly Tuesday. Fourth, mining stocks are now deeply discounted relative to the underlying metal prices. If you believe gold stays above 5,000 and silver stays above 80, mining stocks at these levels represent significant value. The leverage works both ways, and right now that leverage is creating opportunity for those brave enough to buy when others are panic selling. Fifth, the profit taking is healthy for the long-term trend. Markets that go straight up without corrections end badly. The parabolic moves become unsustainable. The corrections, as painful as they are, reset sentiment, clear out leveraged positions, and create a stronger foundation for the next leg higher. Sixth, geopolitical tensions aren't going away. The Iran situation may de-escalate through diplomacy, or it may escalate further. Either way, the structural drivers of geopolitical uncertainty remain. Russia-Ukraine continues. U.S.-China tensions persist. The Middle East remains unstable. These are the macro conditions that have driven the monetary metals higher, and they're not resolving anytime soon. Let me tell you what I'm watching over the coming days and weeks, because the next moves will tell us a lot about which scenario is playing out. First, I'm watching the dollar index. If the dollar continues strengthening, that's a headwind for all the momentum trades. If the dollar stabilizes or weakens, that removes a significant pressure. Second, I'm watching the bounce attempts. Does gold hold above 5,000? Does silver hold above 80? These are psychological levels that matter. If they hold and we see buying emerge, that suggests the worst of the selling is over. If they break lower, we could see acceleration to the downside. Third, I'm watching the mining stocks relative to the metals. If mining stocks stabilize while metals continue falling, that's actually bullish, because it suggests the smart money is accumulating miners at discounted prices. If miners keep falling faster than metals, That suggests more pain ahead. Fourth, I'm watching South Korea and the memory chip names specifically. Samsung and SK Hynix have been leading indicators for risk appetite in the AI trade. If they stabilize and bounce, that's bullish for the broader momentum theme. If they continue falling, it suggests the AI enthusiasm is cooling. Fifth, I'm watching oil prices and the Iran situation. If oil continues spiking, if military escalation continues, if the conflict spreads, all of these impact the inflation outlook and the monetary policy response. The relationship between oil, inflation, rates, and metals is complex and ever-shifting. Sixth, I'm watching volume and open interest in the futures markets. Are new longs coming in on the dip, or are more positions getting liquidated? The futures market data tells us about positioning and conviction. Now let me speak to different segments of this audience because I know we have people at different stages of their investing journey. For those who have been in gold and silver for years, you've seen pullbacks before. You've seen 20% corrections that felt like the end of the world, only to see prices recover to new highs. Tuesday was violent, yes, but it wasn't unprecedented. The long-term thesis remains intact. Central bank buying continues. Industrial demand grows. Currency debasement accelerates. These are the drivers, not daily price action. For those who are newer to precious metals, understand that this is what volatility feels like. You cannot capture the upside of a multi-100% move without enduring days like Tuesday. The question is whether you have the conviction and the time horizon to hold through the turbulence. If you're trading on leverage, Tuesday probably hurt badly. If you're holding physical or long-term positions, Tuesday is noise. For those watching from Asia, and I know many of you are, you've seen these cycles before. Asian buyers have historically been the strong hands in precious metals, accumulating during weakness and holding through volatility. The Shanghai premium, the physical demand from China and India, these are the factors that ultimately drive price discovery regardless of paper market manipulation. For those watching from South Korea, Tuesday's crash in EWI was severe, but the memory chip thesis hasn't changed. AI isn't going away. Data center build-out continues. Samsung and SK Hynix remain dominant in their markets. The question is whether you believe in the structural demand story or whether you think the momentum has permanently shifted. Let me give you some specific numbers to watch because levels matter in markets. For gold, 5,000 is the big psychological level. Tuesday's low was right around 5,020. If gold can hold above 5,000 and bounce, that's constructive. If it breaks below 5,000 convincingly, the next support zone is around 4,700 to 4,800. Below that, you're looking at the 4,500 area. For silver, $80 is critical. Tuesday took us right to the edge of that level. A sustained hold above 80 suggests the selling pressure is exhausted. A break below 80 could trigger another wave of liquidation towards 70 or even 65. For the mining stocks, watch the GDX and GDXJ ETFs for gold miners, and SEL and SILJ for silver miners. These give you a read on the sector without having to track individual names. The ratio of GDX to gold tells you whether miners are outperforming or underperforming the metal. Right now, after Tuesday, that ratio suggests miners are deeply oversold relative to gold. Now I want to address something that several of you have asked about in comments on previous videos. How do you actually navigate this volatility? How do you avoid getting shaken out before the big moves? First, know your time frame. Are you trading the daily chart looking for short-term moves, or are you investing on a multi-year thesis about monetary debasement and physical scarcity? These require completely different approaches. If you're a long-term holder, Tuesday's move shouldn't change anything about your strategy. If you're a short-term trader, you need to have had stops and risk management in place before the move happened. Second, position sizing matters enormously. If you're sized appropriately for your account and your risk tolerance, even a 10% down day is manageable. If you're over-leveraged, chasing maximum returns, a 10% down day can wipe you out. The biggest mistake I see is people sizing positions for the upside they hope for rather than the downside they can withstand. Third, have a plan before the volatility happens. Know what you'll do if price drops 10%. Know what you'll do if it drops 20%. Know what you'll do if it drops 50%. When you have a plan, you can execute rationally instead of reacting emotionally. Tuesday tested a lot of people's plans. Some had them, some didn't. Fourth, understand the difference between price and value. Tuesday changed prices dramatically. Did it change the fundamental value of gold as a monetary asset? Did it change the fundamental value of silver's industrial applications? Did it change the fundamental value of memory chips in an AI-driven world? If your assessment of value hasn't changed, then the change in price represents opportunity, not disaster. Let me share my perspective, and I want to be clear, this is just my view and not financial advice. Days like Tuesday are where long-term wealth is built. The people who bought gold during the 2008 crash are very happy they did. The people who bought silver during the 2020 panic are very happy they did. The people who bought South Korea during the 1997 Asian financial crisis are very happy they did. Panic creates opportunity for those who can see through the fear. But timing matters. Tuesday might not be the low. We might see more selling. We might see those support levels tested and broken. The Iran situation could escalate. The dollar could strengthen further. The liquidation cascade could continue. Anyone who tells you they know exactly what happens next is lying. What I focus on is the long-term trend and the fundamental drivers. Gold has been in a bull market driven by central bank accumulation, currency debasement, and geopolitical uncertainty. Has any of that changed? No. Silver has been in a bull market driven by investment demand and industrial usage growth, particularly around AI and green energy. Has any of that changed? No. South Korea has been outperforming, driven by memory chip dominance in an AI-hungry world. Has that changed? No. Tuesday was a technical shakeout within structural uptrends. That's my assessment. But I could be wrong. That's why I present both sides. That's why I tell you to do your own due diligence. That's why I never tell you what to buy or sell. Let me give you the key takeaways from everything we've covered, because this has been a lot of information. First, Tuesday saw massive crashes across the momentum trades of 2026. Gold down over 5%, silver down over 11% at the lows, South Korea EWI down 14%, mining stocks crushed with some names down 13%. This was one of the most violent days of the year. Second, despite the crashes, year-to-date performance remains strongly positive. Gold still up 16%, silver still up 15%, South Korea still up nearly 30%, silver is still up 161% year over year. The pullback is severe, but the uptrend remains intact on longer timeframes. Third, the selling doesn't match the narrative. Safe haven assets selling off during war escalation is unusual. This suggests forced liquidation, profit-taking, and momentum unwinding rather than fundamental selling. Someone got caught over-leveraged and had to liquidate. Fourth, the fundamental drivers haven't changed. Central bank gold buying continues. Silver industrial demand grows. AI memory chip demand expands. These are structural forces that operate over years, not days. Tuesday was a technical event within fundamental uptrends. Fifth, the levels to watch are gold 5,000, silver 80, and whether mining stocks stabilize relative to the metals. These will tell us whether the selling is exhausted or whether more pain is ahead. Sixth, position sizing and time horizon determine whether days like Tuesday are disasters or opportunities. If you're appropriately sized with a long-term view, this is noise. If you're over-leveraged trading short-term, this is devastating. The unresolved tension is this: war is escalating and safe havens are selling. The momentum trades that define 2026 are experiencing their worst day in months. Does this mark the end of the run? Or does it mark the best buying opportunity we've had all year? The coming days and weeks will answer that question. Now here's what I need from you. If this analysis helped you understand what happened Tuesday and what it means for what comes next, hit that subscribe button. Looking at the numbers right now, a large percentage of you watching aren't subscribed. If this content adds value, subscription is free, and it's how we grow this community of informed investors. Make sure you join our WhatsApp community. The link is in the description. That's where we discuss these developments in real time, share updates as they happen, and connect with others who actually want to understand markets, rather than just react to headlines. Follow us on X at Mr. AG Asian Guy. That's where I post quick updates throughout trading sessions across Asian, European, and American markets. Drop a comment below with your outlook. Do you think Tuesday was the low? Do you think we see more selling? Are you buying the dip or waiting for lower? And don't forget to tell me where you're watching from. I want to see how global this community has become. The data is clear on what happened Tuesday. The question is, what happens next? And that's something none of us knows for certain. All we can do is understand the fundamentals, watch the technicals, manage our risk, and position according to our time horizon and conviction. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frames. Are you trading the hourly chart or investing on a yearly thesis? Plan and position accordingly. Days like Tuesday test your conviction. They test your preparation. They test your risk management. How you respond determines your long-term success more than any single day's price action. This is Mr. AG Asian Guy. Join the WhatsApp community. Follow us on X, and I'll see you in the next one. Stay sharp out there.